Target stock has been in a free fall, down more than 60% since its peak. And for a company that once felt like a retail fortress, that's a serious gut punch. So what happened? Did Target lose its mojo? Or is this just the market throwing a tantrum? In today's video, we're diving deep into one of the most talked about retailers in America. We'll break down why the stock took such a massive hit, look at what the numbers are really telling us, and calculate the company's intrinsic value to figure out if this red and white giant is actually a value investor's dream. But you know what's my dream? It's the fact that you will click the like and subscribe buttons to help grow my channel. Thank you, and now on to the video. Alright, let's talk about what's really going on at Target right now. Target isn't just some forgotten brand, it's one of the largest retailers in the US. It has nearly 2,000 stores and a massive online presence. But despite all that, the stock has been taking a beating. Why? Well, the last earnings didn't help. Revenue came short, earnings per share missed expectations by a wide margin, and foot traffic is down. The company's CEO even admitted that the customer uncertainty is weighing on results. People are pulling back, especially on non-essentials. And then there's the bigger picture. Inflation, interest rates, and shifting consumer habits. People are becoming more sensitive on where they spend their money, and that's putting pressure on retailers like Target, who serve both budget-conscious shoppers and trendier spenders at the same time. Add in some missteps like overstocking the wrong inventory and getting hit with one-time cost adjustments, and you have a recipe for declining margins and investor frustration. So while Target is still a strong brand operationally, it's clearly in a transitioning phase. It's trying to adapt to a new, more cautious consumer while dealing with the fallout from a few tough quarters. Now here's where things get interesting and what people might be overlooking. Despite all the negative headlines and weak earnings, Target stock is trading at one of its lowest valuations in over a decade. The current price-to-earnings ratio is around 10.5. That's 36% below its 10-year average of around 16.5. So the big question now is, has the market overreacted, or is there something deeper going on under the hood? Let's dig into the numbers and look for red flags or signs that Target could be turning a corner. So, to analyze Target's financials, I'll be using Seeking Alpha. It's a great tool, and if you would like to use it yourself, you can find discount affiliate links in the description down below. So, on to Target. The company is currently trading at around $96 per share, and it's down quite a bit from its all-time high in 2021. It's trading at a fairly low forward PE ratio of 13, and they're issuing a fairly high dividend of over 4%. Looking at their revenue, it seems like it has been growing for the last 10 years. We can also see a clear jump in the post-COVID inflation boom, and it seems like over the past 2 years, the company's revenue is seeing a correction. For net income, the numbers seem to resemble the same thing as revenue did. It currently has stabilized at around $4 billion. Another thing we like to see is the fact that Target has been buying back shares fairly heavily. They have bought back around 20% of their outstanding shares since 2018, basically increasing your share of the company along the way. Target's net debt has been growing quite a bit. It has almost doubled since 2018, and they currently have around $16 billion in net debt compared to their market cap of around $40 billion. Let's see their free cash flow to understand if this debt might be too high. So they are currently doing around $3 billion in free cash flow, which means that it would take around 5 years of their current free cash flow to pay down their net debt. This is not the greatest number, however, it's fairly normal in the retail sector, so I do not see it as a red flag. Finally, there's one more thing I'd like to show you. This is a graph that compares Target's revenue to its price over the last 10 years. And as you can see, the company's price is currently at the lowest point compared to its revenue, a great indicator that the company might be undervalued. Alright, now that we went through Target's financials, I can't say I found a lot of red flags there. So let's pull out my intrinsic value calculator and check the company's valuation to see if the company could be a potential buy at its current valuation. Alright, so let's put in the Target ticker symbol. Now let's add their 2024 EPS, which was $8.94. For the growth rate, let's say the company stays consistent with the inflation and grows around 3% a year for the next 10 years. And let's keep it at an average 10% discount rate. With all of these numbers combined, its current intrinsic value comes out to be $108, which is around 10% below its current price, and signals that the company might be slightly undervalued. However, if we would expect to get a 15% return, the numbers change. Suddenly, the company seems overvalued. But in my opinion, the terminal multiple of 10 is fairly low. As we saw before, their average is closer to 15. So if we change it to 15, we can see that the company's intrinsic value is fairly close for a 15% annual return. It all depends if a company will have a multiple expansions from now on. So, despite recent setbacks, Target still has strong fundamentals. Yes, they have hit a rough patch, but the core business remains solid, and management is actively working to get margins back to historical levels. In my opinion, this isn't a screaming deal, but it is a decent opportunity. The market seems overly pessimistic, and as long as Target manages to normalize its profit margins, I do not see the stock performing badly at all. Additionally, right now, Target is trading well below its average PE ratio. If the business stabilizes and earnings improve even modestly, there is serious potential for multiple expansion. That means not just recovering, but compounding returns from both the earnings growth and a re-rating of the market. And if that plays out, I could see the stock as a fairly straightforward double or even triple in the next few years. It all depends on the company's execution, but for patient investors, this might just be one of those overlooked opportunities hiding in plain sight. But what do you think about Target? Are you yourself personally invested into the stock? Leave your comments in the description down below. If you enjoyed the video, consider subscribing and clicking the like button. And as always, guys, thank you for watching, and I hope to see you in the next one. Bye.